Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. Well, I hope you had a chance to look at the weekly market report from last week so you can see once again how accurate technical analysis is as a forecasting tool. And as you can see here, this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And I've left my lines on the chart from last week's report so you can see the evidence of how well this works. Now again, last Friday was right here, and I put out the report on this day, right there on the 23rd, and I said that the market would pull back to test this support level, which is the 20-period moving average, and then I said we would bounce with the end of this line being my target. Now, interestingly enough, we hit the target actually on Monday before pulling back to my support level, and then we went right back up. So there's a lot of different things going on here in this chart, and I'd like to break that down for you. First of which is this long red candle, which when you put this together with the previous green candle here from Wednesday, this forms a bearish engulfing pattern. And that is something that you need to pay very close attention to, because next week is a shortened trading week, and a lot of the fund managers and traders will lighten up on their positions. So we could see a little bit more volatility next week than we did this week. And that's a lot to be said, because this week we had some extreme volatility, as I'll get to towards the end of this report. So my forecast was 100% accurate on this. And what I like to do is forecast the market for next week and show you what I think will most likely happen. And that is an actual repeat of what we saw this week. Now, again, let me show you. This little green candle, that's a spinning top. That's what that's called. And it looks like a little child's toy. That's what the Japanese labeled it many hundreds of years ago. And that's a spinning top. That's usually a sign of an indecision. So the fact that we closed just a hair over that 20-period moving average tells me that we might go up just a little bit, because it's giving these sellers a break. I think today what we saw in the Dow was actually a lot of short covering, which actually caused us to go up a bit towards the end of the day. But this little tick mark right here is going to be my early forecast for Monday and or Wednesday. But then what I think we're going to see is a downturn in the market to test this support level right here. Now, again, this support level was drawn last week, and on Thursday we closed just pennies over that support level before bouncing. So I think we're going to go up. I think we're going to come down. But ultimately, over the next few weeks, I think we're going to wind up a lot lower. So be very careful with any new positions you take. I would protect all of them. I would put stops. I may even use options for the option traders to put some protective puts in there. But be careful that you don't overload your long position at the top of this market, because the volatility is starting to heat up. And as I talk about the VIX, you'll know that the volatility is inversely related to the market. So as the market starts to increase in volatility, that leads to bearish signals down the road. So that's for the diamonds. If I look at the Russell 2000, which is a more broad-based index, again, the percentage of accuracy remains at 100%, where I said we would move up. With the Russell, it was a little bit different than the Dow. I did not think the Russell would pull back a bit. I said we would go up, and this is the line that I drew from last Friday. And you can see here on Thursday we came within pennies of hitting my target right there. So that is going to be taken as a win for us in the forecasting department. But with the Russell 2000, I think we're going to see the same thing as the Dow, with a little bit of a twist in that I think the Russell 2000 could actually come back to test the 20-period moving average, maybe bounce a little bit, and then I think the Russell 2000 is going to start to head lower. Now, this is the first time I've done a zigzag forecast line like that, but the Russell 2000 carries a lot more weight than the Dow, with the Dow representing only 30 stocks. Obviously, the Russell 2000 is 2,000 stocks. So that's going to be my forecast for next week on the Russell 2000. Now, if we look at the spiders, which is the S&P 500 ETF, and you'll see, again, we have another win here with the forecast. Early on Monday, we came up to my target area right there, and then we pulled back with, again, another bearish engulfing pattern on the spiders. This resistance line that I drew last week held, and a lot is going on here that you may not be paying too much attention to. So let me explain this for you. As I erase all my lines right now, I'm going to show that this 20-period moving average is starting to curve lower. So that's turning. The last time we saw that moving average turn like that was back here, back in March. And you can see what happened after the moving average started to follow. We saw a dramatic downturn in the market right there. And that was without a bearish engulfing pattern. So now you have the 20-period moving average rolling over with a bearish engulfing pattern right there. So my forecast is going to be, believe it or not, a slight bounce to test that moving average as resistance. I think that's what's going to happen. We're going to go up and then pull back from that point where we'll start to see the sellers come in and possibly even break down below this low from yesterday, that being the most recent support level. So the S&P is a lot more bearish than the diamonds and even the Russell 2000. So if you have positions in that area, again, I would recommend you protect them. That's the best thing you could do, is use good risk management principles here to protect your money. And then we'll look at the markets as a whole. Now, if we look at the Qs, which represents the Nasdaq market, we had a spike in the market. We came within pennies of that high, didn't quite hit the high, so I'm not going to take 100% credit on that, but we can take a partial credit on the forecast where it did go up. And then we see a dramatic move in the Nasdaq. Now, here again, like the S&P 500, we have the moving average is starting to roll over and go lower. And that is significant because, as you can see here, as the Nasdaq started breaking down and staying down below the 20-period moving average, the volume down here was increasing quite dramatically. So that tells us that the sellers are actually getting motivated. So like the S&P 500, I think the Qs will bounce a little bit, just a slight recovery, but not much. And then I think we're going to go lower from there. So keep an eye out on the Qs. Now finally, let's talk about the volatility index. That's the VIX. My forecast was 100% accurate on the VIX, where I actually left 2 weeks of forecasting lines in place so you can see. And what happened is we pulled back exactly like I said it would the week before last. Last week I said that we would rally in the volatility index, with the end of that line right there being my target. Yesterday, not only did we hit my target price for the VIX, but we blew through it in a big way. You could see that on this day, Thursday, the volatility index went from 970 all the way up to 15. Now this is a very confusing signal for a lot of people, because you think, well, if the volatility index is increasing by 50%, then why didn't the market drop in a significant way? Well, the way to explain that is to go back and look at the past. In the past, when the volatility index had spiked up, it pulled back a little bit before going much higher. So I'm going to really duplicate that pattern here, where I think the volatility index is going to pull back to the 20-period moving average, and then I think we're going to see another dramatic spike in that volatility index. Remember, like I said at the beginning here, the volatility index is inversely related to the S&P. So when the volatility index starts increasing in a dramatic way, then it's really watch out below, protect whatever you can at that point, maybe even get out of the market, move to cash, keep the powder dry, and then make sure you're playing the market in a very defensive way. So if you'd like to learn more about what we do at The Market Guys, just go to our website, themarketguys.com. Click on the video tab right there. I'll direct you to some areas that might be very helpful for you. And look at the role reversal. It's really right here towards the middle of the page on the left. The role reversal line is something you have to pay very close attention to, not just on the way up, but when you watch this very short video, it's only about 7 minutes long, make sure you understand how the role reversal works on the way down, because I more or less alluded to that with the 20-period moving average acting as support now. But now that prices are dropping below the 20-period moving average, the average has reversed its role and has now become resistance. And I talk a little bit more about that in that 7-minute clip right there for you. So have a great long weekend. Markets will be open on Monday, closed on Tuesday. Be safe, be happy, spend time with the family. For those up in Canada, we'll talk to you next week in the weekly market report and in my trade alerts as well. So have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.